What you're looking at right now is my shared portfolio that I show you guys down below in the description. You can check out down below if you want to see it yourself, but basically it consists of 23 different stocks, 23 different companies of all different types. We have 4 in the growth portfolio that you're seeing right here, and then we have 19 in the dividend growth portfolio, which is full of defensive, high-yield dividend growth stocks. And tied for number 1 position in this portfolio is ticker symbol JPM, JP Morgan Chase. Now, if you watch me and you know my channel, I recently made a video about a company, CAT, which is Caterpillar stock. And Caterpillar throughout 2022 has done phenomenal. It's up 9.63%, which is fantastic considering that we're in a recession and the S&P 500 is down roughly 15-20% or so on the year. And even over the last year, this company's up 11%, and it's pretty much near its all-time high. Now, something I want to mention looking at JP Morgan is throughout the back half of 2022, we're starting to see a pretty big recovery. From its initial lows throughout the year, right at about $100, today it trades at $132. So it's already recovered over 30% from its all-time lows, and you can tell that it started to recover quite a bit considering where we were just a year ago. The losses were not nearly as bad as they were just going back to September, October or so. So we're going to talk in this video a change that I'm planning on potentially making. I'm going to make a big change in December. There's going to be multiple companies that are going to switch around. I've already mentioned Caterpillar, JP Morgan. I'm planning on making one of them, and we're going to talk in this video why that is. We're going to talk about its interest rate exposure, the economic outlook, the own comments directly from Jamie Dimon, the CEO himself, as well as their chief financial officer, the CFO. We're also going to talk about layoffs in 2022, how that will affect JP Morgan, the economy, and the stock market as a whole. Talk about economic cycles, talk about where we are in the cycle, in my opinion, how this will affect JP Morgan, because I think that this little picture right here is critical for explaining the economic cycle and where we're at. And then finally, I'll close out with one of the reasons why I'm thinking of taking it down. It's valuation and how you should be valuing a big bank like JP Morgan Chase. So it's going to be a fun one. We're going to go all into JP Morgan Chase. We're going to load this company up on Qualtrim and take a look at its financials right here. Let's go ahead and get started. But before we get into all that, we have to talk about today's sponsor, MooMoo. MooMoo is a new up-and-coming brokerage that is taking the world by storm. Commission-free trading, level 2 data, advanced technical indicators, earnings calendars to see the date of financial statement releases, and institutional tracking to follow Warren Buffett's portfolio are just a few examples of what MooMoo has to offer. With this being my first sponsor in the channel, I have fully vetted their company and stand behind their vision. MooMoo currently trades on the NASDAQ under ticker symbol FUTU for FUTU and is SIPC insured. If you sign up below using my special referral link, you can get anywhere from 1, 10, or even as high as 20 stocks for signing up when you use my special referral link down below in the description or in the pinned comment down below. Free stock amounts can be as high as $1,000, so sign up now using the link in the description or pinned comment down below. You would help support me and my channel by doing so and give yourself an edge in the world of investing. Thank you so much, MooMoo, for sponsoring this video. Now back to the content. Okay, we're back, and let's go ahead and start by looking at the quarterly revenue and where JP Morgan's at so far in 2022. I want to say I'm quite shocked by how much JPM has grown revenue. This quarter, they put up $32.72 billion, which is a pretty far cry from last year's $29.66, which represents double-digit growth of 10.3%. However, if you look at their cash flow, where they were at a year ago during September quarter of 2021, they were putting up $23 billion in free cash flow, positive number. This year, in this quarter, they put up a negative number of $18 billion, which is a drastic swing from the positive to the negative, and you can see more so lately in the last several quarters, we've had quite a few negative free cash flow numbers. Now, I will say that generally speaking, the way that free cash flow is reported for JP Morgan is a little bit choppy, and some years are way higher and way lower than they're supposed to be because this is a financials. So keep that in mind. It is need to be taken into consideration. So one thing we can look at, in my opinion, is the earnings per share. This is a little bit more stable, but even when you look at that, if you look at last year's September quarter, it was $3.74. This year, it is $3.28, which is about 12% down from where we were a year ago. Keep in mind that also factors in with shares outstanding being lower than we were just 1 year ago. Right now, we sit at 2.961 billion versus last year's 3 billion. So even despite the less shares being available in the market, the earnings per share still came in lower, which is something to note for an investor who is invested in this company such as myself. Now, if you want to look at this, this is something I want to note, and this is all directly from JP Morgan in their most recent earnings statement, and it says that they need to be careful about the impact of QT, which is quantitative tightening, on deposits, deposit migration, lags on deposit repricing, and change in shape of the yield curve. The yield curve is something many investors, including myself, have been worried about, and it's something that I really think you need to look up if you're interested in something such as this. Now, I'm not going to go through the yield curve, that's for a whole nother video, but Google it if you're interested in what that is. It's basically investors being very pessimistic on the economy in the short term. Economic recessions need to take investment security losses. This is something that they're noticing, and they're talking about the economic outlook being, quote, healthy, as you can see right here, but there are fairly significant headwinds in the near future. So as JP Morgan says, they recognize that the US economy is healthy, but they do see significant headwinds in the near future, which I think many of us would agree with. Now, I do want to highlight this. This is directly from the recent earnings call. This is directly from Jamie Dimon, the CEO. In regards to interest rates, he says, I think the way to look at it is, we're fairly neutral at this point to interest rates going up or down. Jeremy said the 19 billion, which Jeremy is their CFO, by the way, please do not annualize that. There are a lot of uncertainties today, and I'm just going to mention a few. We're not worried about them. It's not going to change things dramatically, but it does change things. What's going to be QT's, quantitative tightening's, effect on deposits? How much deposit migration you're going to have in this new technological environment? And there are pluses and minuses on that. And of course, there are lags. There are lags in the consumer. There's going to be some lags in treasury services. There are going to be some lags in commercial banking. So it's just in the back of our mind, and we're going to kind of actively manage that. And the other thing I want to point out is that taking investment securities losses, for the most part, is because we want to sell rich securities and replace them with cheap securities. We don't want to be locked into something we think will get worse and not take a chance to buy something that will get better. So you might expect to see that taking place now. That maybe some securities losses in the future, we can do that. We can do this to manage interest rate exposure, but for the most part, we can do that with swaps too or other things. We just do it the most efficient and effective way. And I want the people managing these portfolios to know that we can sell things we don't want to own and buy things we don't want to own. Other than that, we think it's a very good, strong quarter across the board. Now, Jamie Dimon is one of the best out there. He's one of the most tenured, experienced CEOs in the entire market, and he's one of the most tenured reps in the banking industry in general. Now, he has done very well going through each economic cycle, and I think it is important to notice what we just read and his opinions on interest rates, the economy, and what things look like moving forward. One thing I did want to notice is how he's talking about selling rich securities and buying into cheaper ones, which is very critical for a bank of this size, obviously. Now, I don't want to go through each company. We can name off many different companies here, including Peloton, and Tesla, and Microsoft, and Carvana, DoorDash, Salesforce, Amazon, Meta, Twitter, Walmart, Twilio, Robinhood, Crypto.com, Wayfair, Snap, Rivian. There are many other names included on this list, but you get the point. And if you want to pause and read over each one of these, you can see layoffs into how many of these big tech companies and companies alike have affected the US economy. Now, at what point do these mass amount of layoffs begin to really take a toll on the consumer? I'm not sure. But one thing I do know, every single person that's laid off from every single one of these companies eventually begin to take a toll on companies like JP Morgan Chase, who obviously rely heavily on the economy because this is a cyclical business. Speaking of cyclical businesses, this is something I want to point out in an economic cycle, the type of sectors that benefit. Now, if you look across this, it shows recession, early expansion, middle expansion, late expansion, and then back to recession. It goes round and round in a circle. Now, if we highlight early expansion here, you notice that one of the big benefactors, one of the four listed here, is financials. And of course, that's what we're talking about today, a financials company known as JP Morgan Chase. Now, I think right now we're in the midst of this one right here, a recession, which typically you see consumer staples, utilities, telecom, healthcare companies benefit, and we are getting directly into financials. And so you might be watching this video and thinking, Jordan, right now you have 10% of your portfolio in JP Morgan, and that's probably right. Where we're at right now, the recession, the next big sector to benefit is JP Morgan Chase in the financial sector. And that's right. I think I would agree. When we get out of this recession, it would start to benefit companies like JP Morgan. However, as you can see from the stock chart, I think that's already started to get priced in. See how fast this stock has violently recovered from its 100 shared low to around the 130s? It's recovered quite a bit from that high in the 160s. If you look at this on a year chart, that's when it becomes more apparent. People have already begun to price this in. They've increased the share price roughly 30% from the lows, actually over 30%. And so in my opinion, I think it's time to start hedging against this as consumers and investors has started to hedge against this early expansion. expansion by investing in JP Morgan Chase early. Luckily, I invested before that uproar started to recover, and now in my opinion it's starting to diversify into other investments that still have not recovered at all. Now, I'm not going to go through each and every one of them one by one, but if you look through here, there are many different companies that have not recovered to their all-time highs, and it may be long before they do so. Like for example, if you look at the year-to-date chart on Broadcom, while it started to recover some, it's still down almost 20% year-to-date, and there are many other businesses like that. And speaking of investing in businesses that have not recovered, JP Morgan now trades at a valuation for a banking company that is not that cheap anymore. Now, one of the most common metrics to value a financials company is price to book, and JP Morgan trades at a 1.5. Now that's not cheap, and JP Morgan typically trades at a premium because it is high quality, and it should trade at a premium in my opinion. However, it's not as cheap as many other banks out there that trade at a 1.2, a 1.3, or even as low as a 1 or 1.1. So JP Morgan Chase is one in my opinion that I will not be investing a whole lot into. I don't plan on selling a massive amount of this company if you're following along and investing in the dividend growth portfolio, but I think it is important to notice that now is probably not the best time to be adding into this company, and there are more opportunities in the market in my opinion. So stay tuned. I'll let you know what I end up doing with this change when I make the change, and of course I'll keep you guys invested and up to date as we move along throughout this YouTube channel. Thank you guys so much for watching. Check out all the stuff down below in the description if you haven't already. But other than that guys, thank you for watching, and I'll catch you all next time.